Welcome to The Explainer. Today, we're setting the stage for a seriously data-driven showdown. We're talking about a heavyweight battle between the absolute loudest names in the stock market and its quietest, most unassuming champion. We'll be looking closely at the investing landscape of 2026, a year that was just packed with massive headlines, water cooler bragging, and wild market swings. So if you've been feeling the pressure to pick the quote-unquote perfect stock, or maybe you're just wondering if your current strategy is leaving money on the table, you are in exactly the right place.
Plus 127%. Just pause and think about that for a second. That is the staggering gain NVIDIA saw right at the start of 2026. Literally, if you had bought NVIDIA on day one of the year, your money would have more than doubled in an incredibly short amount of time. And look, when you see a number like that flashing on your screen, it grabs your attention, right? It creates this almost undeniable FOMO, fear of missing out. It makes you feel like the wealth of a lifetime is just sitting right there, waiting for you to pick the right ticker symbol.
Now, if you were one of the lucky few who actually bought in and rode that wave, did you crack the code? Because catching a game like that feels absolutely incredible. It feels like you've outsmarted Wall Street, like you found the ultimate cheat code to building wealth. But I'm here to tell you about a hidden reality, one that the flashy headlines completely ignore. And that reality? It's that VOO, a simple index fund, quietly beat the majority of individual stocks this year. Again. And yep, I have the numbers to prove it. Okay, let's dive into this. Section 1, the 2026 stock hype, why we chase the noise. Seriously, why do we do this to ourselves? Why do retail investors fall into the exact same trap every single year? It's kind of a fascinating psychological loop, actually. When markets start moving, the financial news networks turn up the volume, and suddenly, everywhere you look, someone claims to have the next big winner. We chase the noise because, well, human beings are wired to seek out outsized rewards. In fact, as the headlines got exceptionally loud in 2026, the phrase best stocks to buy right now spiked right alongside the market rallies. Millions of people sitting at their keyboards, desperately trying to find a magic crystal ball that would tell them exactly where to put their cash to replicate those triple-digit gains.
And here's the psychological trap. You easily see the winners. You see the 80%, the 100%, the 150% gains. These are the ones your coworker brags about by the coffee machine. These are the ones that make you look at your own portfolio and completely question your strategy. But what you're missing is the full picture. It's called survivorship bias. For every massive winner splashed across the news, there are dozens of hyped stocks that plummeted, stagnated, or just completely wiped out investors' capital. We only ever remember the ones that survived and thrived, and that fundamentally distorts our perception of risk.
Moving on to Section 2, meet the contenders, 2026's most hyped stocks.
Think of this like the tail of the tape before a major heavyweight bout. We're bringing out the biggest, flashiest contenders of the year, the exact stocks real people were eagerly Googling, debating, and buying in 2026. First up, NVIDIA, the undisputed AI king driven by the massive rollout of their next-generation architecture. Next, Alphabet, Google's parent company, boasting aggressive AI integration across its workspace paired with dominant ad revenue. Then we have Tesla, always controversial, dealing with volatile sentiment around their vehicle delivery numbers and autonomous timelines. Fourth is AMD, heavily hyped as NVIDIA's biggest challenger, making a huge push for data center market share. And finally, Amazon, where their cloud computing division, AWS, was basically printing money and breaking new revenue records. These were the absolute heavyweights of 2026.
Wow. Section 3, the VOO reality check, the scoreboard.
So let's step away from the high-energy hype for a second and establish our baseline, VOO, Vanguard's S&P 500 ETF. Now, it doesn't have a charismatic CEO, it doesn't launch rockets or build revolutionary AI chips, but capturing the weighted performance of the top 500 companies is an incredibly resilient wealth-building machine. It's basically a self-cleansing mechanism that naturally phases out the losers and rewards the winners, absorbing individual market shocks along the way. Honestly, it's the textbook definition of a steady, grounded approach to long-term capital appreciation.
Now, what's really interesting about this slide is that when you line up these massive names against VOO, the danger of stock picking becomes crystal clear. NVIDIA had its historic run, sure, but the others faced some severe turbulence. While investors were guessing which of the remaining four would mirror NVIDIA, they got hit with missed earnings, unexpected executive departures, and aggressive macroeconomic corrections. Alphabet and AMD both saw massive intraday swings that triggered panic selling from retail investors. Tesla dealt with severe drawdowns before managing any sort of recovery. But by averaging out those chaotic ups and downs of trying to guess the right individual stock, VOO quietly beat the majority of this specific, highly hyped list. The index funds simply absorbed the volatility and delivered a consistently powerful return. It proves, yet again, that the steady approach outperforms the chaos.
Which brings us to Section 4, why boring always wins. The ultimate takeaway. Mathematically and psychologically, removing the guesswork is just a smarter way to invest. When you aren't constantly refreshing your portfolio, or stressing over every single earnings call, or agonizing over when to sell a hyped stock, you actually allow compound interest to do its job uninterrupted. It's summarized perfectly by this quote from our analysis. You're seeing the winners. You're not seeing the full picture. I really want you to internalize that. The media and finance influencers, they are only ever going to tell you about their massive wins, to make investing feel like this lottery that you're missing out on, rather than a systematic process of wealth accumulation. So instead of fighting the noise, you can use this 2026 data to build a stress-free strategy. Step 1, recognize the FOMO trap. When the headlines get flashy, know that they are designed to grab your clicks, not build your wealth. Step 2, remember survivorship bias. For every stock that goes to the moon, there are dozens that crash back to Earth. You're playing a really dangerous game of probability when you pick individual names. And step 3, choose the quote-unquote boring but incredibly powerful compounding of VOO. Let the top 500 companies in America work for you without you having to guess which one will be number 1 tomorrow.
All this brings us to the ultimate question, one you have to answer for yourself. Next time you open your newsfeed and see a stock jumping 100%, what are you going to do? Will you let the noise drag you back into chasing the hype? Or will you have the discipline to step back, look at the full picture, and confidently embrace the boring? The data shows us exactly who wins in the long run. The choice of how you play the game is entirely up to you.
All right, let's jump right into this explainer and unpack the absolute massive hype around picking individual tech stocks versus keeping things incredibly simple. Look, if you've been following the markets at all lately, you know exactly what I'm talking about, right? Everywhere you look, there's another headline screaming about the next big breakout, the must-have tech giant, and these fortunes people are supposedly making overnight. But today, we're going to completely ignore the noise and look straight at the hard data. We're pitting the high adrenaline world of stock picking against a much quieter, foundational approach. So, it all really boils down to one core question. Is the tech stock hype actually worth it? I mean, it is so incredibly tempting to chase those high-flying marquee names. We all kind of want to find that one golden ticket that just magically doubles or triples in value. But does constantly hunting for those individual winners actually pay off for the everyday investor when the dust finally settles? Well, let's establish our baseline to figure that out. For our benchmark today, we're using VOO. It's an exchange-traded fund that simply tracks the S&P 500. This is going to be our completely stress-free benchmark for 2026. And you know what makes it so compelling and why it's the absolute perfect counterweight for our analysis? Holding it requires zero stock picking, zero late-night research, and virtually zero stress. You are literally just buying a slice of the 500 largest companies in the US economy and just going along for the ride. Section 1, VO versus the hype.
Okay, let's look at the 2026 year-to-date performance. We're putting VOO up against some absolute undisputed heavyweights here. NVIDIA, Alphabet, Tesla, AMD, and Amazon. These are the marquee names everyone has been endlessly hyped about. But what the data actually reveals is honestly pretty shocking. Requiring absolutely no effort, VOO matched or beat the majority of these exciting stocks. Out of all these titans of industry, the simple S&P 500 tracker came out ahead or perfectly level with most of them. And here's the real kicker from our source material. That's not a fluke. This specific outcome, where the broad index matches or beats the majority of the hottest individual stocks, happens almost every single year.
Now, I know what you're thinking. Yes, NVIDIA did beat VOO on paper. It had a massive run. But before we go declaring stock picking the ultimate winner, we have to ask a deeply uncomfortable behavioral question. Did you actually buy it at the right time? This is the huge catch that data emphasizes. It's so easy to look at a chart in hindsight and calculate your hypothetical millions, right? But in reality, did you perfectly time the bottom? Or did you buy into the hype at the absolute top when literally everyone else was talking about it? Because capturing that full percentage gain is incredibly rare for the average person. Take a case like Alphabet, for example. Its performance was really close to VOO, maybe slightly above it, depending on the exact date you check. You've got to think about what you were trading for that tiny little sliver of outperformance. You took on concentrated single stock risk for barely any extra gain. Think about it. If Alphabet has a bad earnings call, some unexpected regulatory issue, or a leadership change, your portfolio takes a direct heavy hit. But with VOO, a single company's bad day is just a drop in
try to pick individual winners. We're talking about taxes, time, and emotional cost. These are basically the three silent killers of stock picking returns. Let's break down exactly how each of these impacts your actual bottom line compared to just using a simple index fund approach. First up is the most guaranteed cost of them all, taxes. Look, when you're actively trading, buying and selling individual stocks, trying to catch the latest wave or ditch a loser, you are constantly triggering capital gains taxes. Every single time you lock in a profit, the tax man takes a cut, and that really drags down your real-world compounding. Contrast that with VOO. An S&P 500 index fund is incredibly tax efficient. Because it's just quietly holding the top 500 companies, there's very little internal turnover, and that means fewer taxable events for you while your money just sits there and grows.
Then you've got the cost of your time. Think about the sheer number of hours demanded by stock picking. You have to read quarterly earnings reports, decipher forward guidance, listen to CEO calls, and sit there watching price charts at 11 p.m. trying to predict what the market will do the next morning. It's literally an exhausting second job. But with VOO, 0 hours required. None. You buy it, you hold it, and you go actually live your life, spending your time on things you genuinely enjoy while the market does all the heavy lifting for you.
And then there's the final, and honestly perhaps the most devastating hidden cost, the emotional toll. Imagine holding an individual stock, like a Tesla or an AMD, and it suddenly drops 30% on some bad news. Can you actually hold on to it? The data shows that most people simply can't. The stress is just way too high, and they end up panic selling at the absolute worst possible time, permanently locking in those losses. VOO prevents you from ever betting on just one company. Because your bet is broad and spread across the entire US economy, those terrifying single stock drops are completely absorbed. It makes it infinitely easier to hold on to your investments for the long haul without letting pure panic dictate your financial future. This whole crucial point is summarized perfectly by this quote straight from our source material. Even when a stock wins on paper, the real-life investor often doesn't capture those gains. And it makes total sense, right? By the time you factor in the mistimed buying, capital gains taxes, the endless hours of lost time, and the inevitable panic selling during a downturn, that shiny percentage gain you saw on the chart is pretty much completely gone in reality. Section 3. Who really wins? So I want to leave you with this final critical thought as you evaluate growth. Are your investments capturing real wealth, or are you just paying for the illusion of hype? The data clearly shows that simplicity, tax efficiency, and broad diversification almost always lead to better real-world outcomes than constantly chasing the next big tech stock. So take a hard look at those hidden costs in your own strategy and really ask yourself, is the thrill of the chase actually worth the price?
Welcome to This Explained. You know, I was recently digging through some historical market data, and it completely shattered the myth that you have to be glued to a glowing wall of monitors to build real wealth. Today, we're going to explore the hard numbers behind why a simple, foundational VOO strategy almost always beats out high-stress active trading. Let's jump right in.
Okay, let's dive into Section 1, the power of compounding. So, to really see the ultimate proof of passive investing math, let's play a little game. Transport yourself back a decade, to 2016. Imagine you took exactly $10,000 and put it straight into VOO. You didn't try to pick the next massive tech startup, you didn't obsess over timing the market, and you absolutely never stayed up late biting your nails while watching CNBC or checking the futures market. You just made the deposit, closed the laptop, and went on with your life. What exactly happens to that money?
Well, the data gives us this massive number, $33,946. It's actually fascinating, right? Because achieving this didn't require insider tips or perfectly timing the market. It is literally the direct result of the S&P 500 delivering a historical annual return of around 13% over the past decade. It happens simply because we let compounding do its job, day in and day out, reinvesting those dividends and just riding the long-term upward trajectory of the broader market.
When you look at this, on the left side, we see the quiet, beautifully boring victory of letting compounding do its job. It takes virtually zero effort. But now contrast that with the chaotic reality on the right. Imagine jumping in and out of hot stocks every single year, triggering capital gains taxes, you're making timing mistakes, like buying high on hype and selling low on panic, and honestly, you suffer the sheer exhaustion of trying to outsmart algorithms. Compounding and consistency on the left consistently crushes the high-stress trading on the right.
Moving on to Section 2, the 5 to 10% rule.
Now, I want to be clear here. Picking stocks isn't necessarily always wrong. If there's a company you love or an industry you understand deeply, taking part in that can make sense. But doing it safely requires a strict framework first, before you even think about buying shares of that buzzword
That right there is your foundation. That's VOO, doing the heavy lifting. It's stable, it's diversified. Then, look at the 10% slice. If your foundation is completely set, putting 5 to 10% of your overall portfolio into individual stocks you genuinely believe in, that is totally reasonable. It satisfies that itch to actively invest while completely insulating you from catastrophic loss.
But here is the core warning from the data. If you skip your foundational index fund contributions just to free up cash for a hot stock pick, the math immediately turns against you. VOO absolutely must remain the core of your strategy. Abandoning that foundation to chase what's essentially a lottery ticket, that destroys the long-term mathematical advantage of compounding we just explored. Don't let FOMO ruin your math.
Which brings us to Section 3. Consistency wins every time. When we look at the data over the long run, here's the reality. Most individual stocks fail to beat the broader index. And those very rare few that actually do beat it, they usually come with massive volatility and uncalculated risks that everyday investors simply don't account for. This quote really captures the whole shebang perfectly. The smartest investors aren't the loudest ones, they're the consistent ones. Seriously, let that sink in. The folks bragging at parties or screaming on social media about their wild crypto gains or one lucky options trade, it's just noise. The true secret to wealth building is being the quiet, disciplined investor who relentlessly funds their foundation year after year. So I'll leave you with this. The next time you're tempted by a notification about the next big breakout stock, ask yourself, is your financial foundation built on concrete or is it built on noise? If you want to see exactly how to implement a concrete VOO strategy from absolute scratch, step by step, I highly recommend checking out our next explainer. And hey, if this explainer helps you view investing through a clearer, more logical lens, make sure to subscribe. Empowering you with this kind of focused learning is exactly what we do here. Thank you so much for joining me, and I'll catch you in the next explainer.